Position sizing is a very important aspect of trading. It can mark the difference between an expected loss and a loss that completely devastates your trading account. Although it is a money management tool, some traders don't realize its potential for optimizing trades, and that's what we'll be covering in this video. Let's get started. Before we get started, pause the video and take some time to read our risk disclosure. The risk of loss in the trading of stocks, options, futures, forex, foreign equities, and bonds can be substantial and is not suitable for all investors. To read our full risk disclosure, go to our website, halifaxamerica.com, scroll to the bottom of the homepage, and click on any link to view the risk disclosure that matches the markets you are trading. Just about every trader is familiar with the idea of position size. Your position size is the number of shares or lots you buy or sell to enter a trade. Most of you are familiar with the notion that proper position sizing is a way to manage risk. If you don't want to risk more than a certain amount per trade, you need to size your positions in such a way that you won't lose more than the limit you set for yourself. But position sizing can also be used to optimize your trades. In other words, there are certain trades in which your optimal position size will not only manage your risk, but optimize your profit potential. Let's take a look at an example. Here is a sequence of 3 trades for a hypothetical stock that yield a break-even result. After commissions, the break-even result becomes a loss. Trade 1 has a profit target of $2 and a stop loss of 60 cents. It gets stopped out, so you lose 60 cents. Trade 2, profit target of $1.50 and a stop loss of 40 cents. It gets stopped out for a result of a loss of 40 cents. Trade 3, profit target of $1, stop loss of 20 cents. This trade actually makes a profit of $1. The gross P&L is 0. The net P&L is, of course, a loss after commissions. Let's suppose you have a $25,000 margin account. This means that your buying power on margin is $50,000, or twice the amount of capital in your account. Let's also suppose that stock XYZ's starting point is at $15. This way, our examples won't run into any margin calls. Let's take a look at what might happen if you place the 3 trades using a fixed size of 500 shares versus position sizing at 2% risk. Trade 1. The first trade has a stop loss of 60 cents and a profit goal of $2. You get stopped out for a loss of $314 after commissions. Your balance is now at $24,686. Trade 2. Your profit goal is $1.50 and your stop loss is at 40 cents. You get stopped out for a loss of $214, including commissions. Now your equity balance is at $24,472. Last trade has a profit goal of $1 and a very tight stop loss of 20 cents. This trade is a winner and you make a profit after commissions of $486. Your ending balance after all 3 trades is $24,958, a loss of $42 or negative 0.16%. Now let's see what might happen if you set your position sizing at 2% risk. Trade 1. Your profit goal is $2 and stop loss is 60 cents. 2% of $25,000 is $500, so you buy 810 shares to match this risk amount. You get stopped out for a loss of $500 after commissions. Your balance is now at $24,500. Trade 2, with a 2% risk of $490, a profit goal of $1.50 and a stop loss of 40 cents, you buy 1,190 shares. You get stopped out for a loss of $490 after commissions. Your balance is now $24,010. Trade 3. For this last trade, your profit target is $1, but your stop loss is very tight at 20 cents. With a tighter stop loss, you can place a larger position than in the previous trades. With a risk limit of $480, which is 2% of $24,010, you buy 2,330 shares. This trade works out and you make a profit of $2,316 after commissions. Your balance is now at $26,326, a gain of $1,326 or 5.3%. Here's the takeaway. Considering that the trades yielded a break-even result, there is a big difference between sustaining a loss of 0.16% and a gain of 5.3%. The difference is not in the trades but in the position sizing. The example in which you risked 2% of your account yielded a net profit. The reason for this is that the profit to risk ratio was larger on the profit side, and that the trade happened to work out. This can sometimes happen. If none of the trades worked out, your position sizing efforts would still have allowed you to anticipate and manage your losses. Hopefully, this example not only demonstrates the value of proper position sizing for managing risk, but also its value in optimizing profit potential, given that you have a favorable risk-to-reward ratio. Thanks for joining us. If you have any questions, feel free to send us an email at team@halifaxamerica.com. You have a good day, and remember to trade wisely.